Every day, drivers pull into gas stations, fill up, tap a card, and leave. From the outside, it looks like one of the simplest businesses in America. Cars arrive, fuel goes out, money comes in, and the sales numbers can look enormous. But this is one of the easiest businesses to misunderstand. A station can move millions of dollars of fuel in a year and still have very little room for error. Because the number on the pump is not the amount the owner gets to keep. Behind every gallon are fuel costs, payroll, rent, card fees, utilities, equipment, maintenance, insurance, taxes, compliance, and often debt. Then there is one risk most retailers never have to think about. What is happening underground? So, do gas stations actually make money? The short answer is, sometimes. But the real business is more complicated than selling gasoline. It is a traffic business, a convenience store business, a property decision, and a cost management problem all at once. In this video, we will build one clearly labeled illustrative scenario for a small independent suburban station in the United States. It is not a forecast, evaluation, or investment advice. It is a way to see why big sales can lead to surprisingly thin profit. Imagine finding an empty lot near a busy suburban road. Cars pass all day. There are homes nearby. The nearest gas station is a few minutes away. It feels like a straightforward opportunity. You would need a site, a building, underground tanks, piping, pumps, a canopy, a convenience store, inventory, staff, permits, payment systems, insurance, and enough cash to survive before the station builds a loyal routine of customers. That list already reveals something important. A gas station is not just a set of pumps. The pumps are the most visible part of a much larger operating system. And if the station has underground storage tanks, the owner also takes on a regulatory responsibility that an ordinary small store does not carry. The Environmental Protection Agency requires regulated underground tank owners and operators to meet release detection, spill, overfill, corrosion protection, record keeping, and financial responsibility requirements. State and local rules can add more. In other words, the business begins with construction and compliance long before the first gallon is sold. Now let us look at the fuel side. The National Association of Convenience Stores says that the average fueling location sells about 2,500 gallons of gas a day. That is an industry-wide average, not a promise for any single location. A weak site could sell far less. A high-volume big-box location could sell much more. But it gives us a useful starting point. At 2,500 gallons a day, a station moves about 912,500 gallons in a year. If we use an illustrative retail price of $3.20 per gallon, that is roughly $2.92 million in annual fuel sales. $2.9 million. That is the number that makes this business look irresistible. But sales are not profit. Most of that money must be used to replace the fuel that was just sold. The Energy Information Administration breaks the retail pump price into broader components: crude oil, refining, taxes, and distribution and marketing. That final category is not the same thing as a single station owner's net profit. It contains costs and profits across a wider chain. So when we see a large price at the pump, we cannot assume the station owner keeps a large share of it. For our illustrative scenario, we will use a fuel gross margin of 38 cents per gallon. Again, that is an illustrative assumption. It can be different by market, by competition, by supply contract, by timing, and by the operator's pricing strategy. At 912,500 gallons a year, a 38-cent gross margin produces about $346,750 of fuel gross profit. Notice what happened. The business went from $2.92 million of fuel sales to $346,750 of fuel gross profit before staff, rent, utilities, maintenance, insurance, or debt service. The revenue number is huge. The margin pool that must support the business is much smaller. That is why fuel can be both essential and dangerous. It brings traffic. It creates daily habits. It makes the location visible. But it can also create a lot of work for every dollar that is actually left behind. There is another complication. A station cannot always react freely when its wholesale fuel cost changes. A competing station across the road may change its price first. A nearby warehouse club may use fuel as a traffic driver. Drivers compare the price on the sign before they ever enter the lot. That means the operator is managing a moving target. Raise the price too far, and volume can fall. Cut the price too deeply, and the margin pool shrinks. Hold the price steady while the fuel cost changes, and the business can be exposed in a different way. This is why a station can look extremely busy and still need careful daily pricing. The business does not get to choose demand in isolation. It is tied to traffic patterns, competitors, commuter behavior, and the local price environment. The fuel sign is visible to everyone. The actual economics behind it are not. This is where the convenience store changes the story. The customer who stops for fuel is already at the site. If they walk inside for coffee, a drink, prepared food, snacks, or other merchandise, the station has a second chance to earn gross profit from the same trip. NACS reported that merchandise and food service represented 35% of average convenience store sales in 2025, but 57.4% of gross profit. That does not mean every item is highly profitable. It means the inside of the store can matter disproportionately to the economics of the site. The pump brings the customer to the property. The store gives the operator another way to make the visit valuable. For our model, we use an annualized merchandise gross profit benchmark of $622,608, based on a NACS average store monthly gross profit figure from 2023. To turn that into a simple illustrative sales estimate, we assume a 35% merchandise gross margin. That implies about $1.78 million of merchandise sales and about $1.16 million of merchandise cost. We also include $69,684 of other annual gross profit contribution, annualized from the same NACS benchmark set. None of these numbers should be read as a typical independent station result. They are a transparent model built from industry benchmarks and explicit assumptions. But now the logic is clear. Fuel gross profit, $346,750. Merchandise gross profit, $622,608. Other income gross profit, $69,684. Together, that gives us about $1.04 million of total gross profit before operating expenses and debt service. But the store is not a magic solution. A larger inside basket has to be earned. The operator needs the right product mix, working refrigeration, enough inventory, clean shelves, fast service, and staff who can keep the store operating during busy hours. Food service can improve the economics, but it can also introduce spoilage, labor, equipment, and quality control costs. A coffee counter or prepared food program changes what the store can earn, but it also changes what the store must manage. That is the difference between a station that simply has a shop attached to it and a station that operates a deliberate convenience business. The customer trip may begin at the pump, but the site has to convert that trip into a purchase inside the store. The station owner is constantly asking a simple question. After bringing a driver to the property, can the business create enough gross profit from the full visit to cover the fixed cost of being there? $1 million of gross profit sounds comfortable, until the station has to operate. Someone has to cover the register, stock the shelves, clean the store, supervise deliveries, manage shifts, and deal with the unpredictable rhythm of a location that may be open early, late, or 24 hours a day. There is property cost. In our scenario, it is a lease or occupancy cost, but a property owner would still have capital tied up in the site. There are utility bills, canopies, refrigeration, lighting, HVAC, pumps, and store equipment all use power. There are payment processing and technology costs. Fuel is often paid for by card. The store needs systems for inventory, sales, and security. There is insurance. There is maintenance. There are pump and equipment repairs. And there is the compliance work that comes with underground storage tanks. For the scenario, we assume $795,000 a year in operating expenses. That includes $360,000 of payroll, $180,000 of property or lease cost, $75,000 of utilities, $70,000 of card processing and technology, and $110,000 for insurance, maintenance, and compliance. Those are not national averages. They are illustrative inputs designed to make the cost stack visible. Then we add another line that can change the entire outcome: debt service. If the site, build-out, equipment, or acquisition was financed, the operator may have a fixed annual payment even when sales are disappointing. In this illustration, debt service is $170,000 a year. Some of these costs can move gradually. A lease can rise at renewal. Wages can rise when the labor market tightens. Electricity costs can change. Insurance can become harder to renew. Equipment that worked reliably for years can suddenly need replacement. And some costs are not visible to the customer at all. They do not show up on the fuel sign or in the store window, but they still have to be paid before the owner can call the remaining money profit. That is why the operating expense line deserves as much attention as the sales line. A business with a modest gross profit improvement can be overwhelmed if its fixed and semi-fixed costs move in the wrong direction at the same time. Now we can calculate the scenario. Total gross profit, $1,039,042. Less illustrative operating expenses, $795,000. Less illustrative debt service, $170,000. That leaves an illustrative pre-tax profit of $74,042. And that is the central lesson. The station in this scenario sold almost $4.7 million of fuel and merchandise combined. Yet after the costs that keep the business alive, the result is only about $74,000 before tax. This is not a statement about every gas station. It is a reminder that a high sales total can hide a thin profit structure. If annual operating costs rose by $100,000, that illustrative profit would disappear. If gross profit fell by a similar amount because traffic weakened, margins narrowed, store sales softened, or costs increased, the result would be the same. That is what thin resilience looks like. Think of the scenario as a bridge with a narrow deck. It can carry normal traffic, but it does not take a huge shock to make the crossing difficult. A few cents of fuel margin pressure, higher labor expense, a repair, a softer convenience store basket, or more expensive financing can all act on the same limited amount of gross profit. This is also why two stations in the same city can have completely different outcomes. One may own its real estate, have older debt, strong commuter traffic, and an efficient store operation. Another may pay a high lease, carry newer debt, face direct price competition, and have weak inside sales. From the street, both locations can look equally busy. The difference is hidden in the cost structure. There is one more layer. Unlike a normal retail store, a fuel site has a critical asset and risk below the pavement. Underground storage tanks must meet technical and financial responsibility requirements. The EPA explains that owners and operators need resources to clean up releases and compensate third parties for damage when a release occurs. For petroleum marketers with 100 or fewer tanks, federal financial responsibility requirements can involve $1 million of per-occurrence coverage and $1 million in aggregate coverage. Requirements vary by business type and throughput, and states can be stricter. The point is not that every station will face a leak. The point is that the downside is not limited to a bad sales month. A station can have a strong location and a full parking lot, yet still be exposed to equipment, insurance, regulatory, and environmental costs that an ordinary shop never sees. So, do gas stations actually make money? They can. But the business is not simply about buying fuel and selling it for more. It is about traffic. It is about store conversion. It is about controlling operating costs. It is about financing. And it is about managing risks that sit below the ground as much as above it. The pump creates the visit. The convenience store, the cost structure, and the operator's discipline decide whether that visit becomes a viable business. This video is educational and uses illustrative assumptions. Results vary by location, financing, and operation. Which business should we dissect next? A car wash, a hotel, or a gym?